Are you ready? So this exercise is all about correcting errors. And let's take a look at this question. So it's asking us to determine the impact of this error that was made by the company on assets, liability, shareholders' equity, revenue, expenses, and net income for both years 2013 and 2012. So here's the error, second paragraph. It says, on December 30th, 2012, the company recorded sales of $180, cost $80, FOB destination. So they recorded a sale in 2012, but the inventory did not arrive in the customer's premises until January 2013. So here's what's going on, right? So they recorded a revenue and the respective cost of goods sold in 2012. But because the sales terms is FOB destination, it means that Cadbury should not have recorded the revenue in 2012 because it didn't arrive at the customer's premises until 2013. So it looks like revenue was recorded too early, in 2012 as opposed to 2013. So, having said that, let's take a look. So first of all, in looking at 2012, why don't we do that separately? So revenue less expenses gives you net income. Assets equals liability, shareholders' equity. So you'll see that revenue is overstated by $180. Okay, and we know that expenses, because the related cost was recorded, is also overstated by $80. So net income is overstated by $100. So in the net income effect, now we're not going to include the expense, the income tax expense associated with the sale, but let's assume there were no income taxes. So we know that in 2012, they recorded the revenue too early and the cost of goods sold was also too early. And that means that the income, net income, is overstated, which means that shareholders' equity is overstated by $100. Now, liability is no effect because there's nothing to do with the liabilities. And the asset is overstated by virtue of balancing this entry is overstated. Why? Well, there are two accounts are affected here, right? First of all, the accounts receivable is overstated by $180 because they recorded a receivable when in fact it wasn't really a sale. Now, the ending in the inventory was understated by $80, okay? Because they should have had an ending inventory of $80 because the units weren't sold. They actually belong in Cadbury's premises, but in fact, they recorded it as a cost of goods sold. That's why the net effect is an overstatement of $100. Now, what happened in 2013? Let's do that same equation again. So what happens in 2013 is they end up recording the revenue. So the revenue is, they did not record a revenue. They should have recorded a revenue, so it's understated by $180. The expense should have been recorded in 2013 instead of recorded in 2012. So the expense is understated by $80. So net income is understated by $100. We know that shareholders' equity is no effect. Why? Because the 2012 overstatement of $100 is offset by the 2013 understatement by $100. We know that liability has no effect, and one would think that the asset has no effect either because the receivable would have already been collected, and it's rightfully so. The receivable should have been set up, and it should have been, and it would have been collected in cash, and the inventory would have been gone already. So that's why there's no effect in the second year. Thank you.